Hello again from me, Louis Rossouw. I'm a portfolio manager at Adviceworx Private Client Securities, and I'd like to spend the next 20 minutes or so talking to you about the economy and markets. I'll also share the Adviceworx house view on prospects for the rest of the year. Without a shadow of doubt, the month's biggest newsmaker was President Volodymyr Zelensky of Ukraine. Under his fearless and charismatic leadership, his outgunned and numerically inferior armed forces have now held back a Russian invasion for more than 5 weeks. Despite this brave resistance, much of Ukraine's infrastructure now lies in ruins, and more than 4 million of its citizens have fled the carnage. But the war has also taken a heavy toll on Russia, and it now seems that the Kremlin will have to settle for a negotiated armistice which will allow it to hold on to its gains in southern and eastern Ukraine. By the end of March, more than 490 million people had tested positive for COVID-19 worldwide, and 6.16 million people had succumbed to the disease. The United States remains hardest hit, with 81.5 million infections to date and more than 1 million deaths. India, Brazil, France and Germany now make up the rest of the top 5, and South Africa is thankfully down to 20th position in terms of the most recorded cases worldwide. Most parts of the world have seen a sharp decrease in the number of new cases being reported weekly, the exceptions being East Asia, Europe and Africa. New weekly deaths are also substantially down, with only East Asia, specifically China, seeing an increase. To date, nearly 2/3 of the world's population have received at least one dose of COVID vaccine. It is estimated that 57.2% of the world's population is now fully vaccinated, and more than 11.2 billion doses of vaccine have thus far been administered. The vaccination rate has understandably come down as a larger proportion of the population has been vaccinated, and in low-income countries there has been an encouraging increase in the percentage of the population vaccinated to date. Inflation in the United States reached a 40-year high in February, with a tight labor market putting upward pressure on salaries and consumer prices. Europe is also experiencing an inflationary surge, but mainly due to sharply higher gas prices. The US has pledged to provide Europe with liquefied natural gas, but many countries, especially in the developing world, are facing balance of payment crises as food and fuel prices spike. US interest rate hikes look set to bolster the dollar, especially since Britain and the Eurozone are more worried about recession than inflation. Some pundits are worried that the world is on the brink of 1970s-style stagflation, when high fuel prices caused the economy to contract while inflation soared. We don't envisage things getting that bad, however. Firstly, economic output is less dependent on fossil fuels than 50 years ago, and secondly, the US economy, which represents a quarter of all global output, is in good shape and self-sufficient in terms of its energy needs. US GDP is forecast to grow by a healthy 3.6% this year, and core inflation seems likely to peak below 5%. Before Russia invaded Ukraine in February, the Eurozone looked set for a bumper year, with above-average economic growth and mild inflation. The quadrupling of gas prices has all but destroyed this Goldilocks scenario, especially in Germany, where nearly half of industrial output is produced using imported Russian gas. Unless the war in Ukraine ends soon and tensions subside, growth in the Eurozone could disappoint and inflation could rise even further. The recent spike in fossil fuel prices has made many people lose sight of the evolving long-term outlook for energy. Oil, gas and coal prices in particular have shot up due to geopolitical tensions and supply constraints, and some cynics are now poo-pooing the prospect of a rapid transition to renewable energy. The fact of the matter is that the world is at an inflection point. Whereas these three fossil fuels provided about 80% of our energy needs in 2020, this number is projected to decline to around 60% by the end of the current decade. Over the same period, renewables share will more than double to 20%, becoming the largest single contributor at 30% by 2035. Atomic energy, the light blue line, looks set to hold its own over the coming decades. Despite severe volatility at first, equity markets ended the month mostly higher. China was the notable exception, with government's love-hate relationship with its big technology firms weighing on the market. Fears that the US Fed will overdo monetary tightening have caused pain in the bond market, and the oil price has come down from its recent highs. The gold price enjoyed a brief rally, and sanctions against Russia boosted the nickel price. Meanwhile, all four major auditing firms have closed shop in Russia. After a torrid first 2 months of the year, equity markets overcame initial jitters and posted solid gains in March. The Nasdaq bounced back strongly, but Mumbai Sensex was the top performing major index, and mainland China's A50 the laggard. Over the past 12 months, the S&P 500 was the best performing index, and Hong Kong's tech-heavy Hang Seng the worst. Over 3 years, the Nasdaq retains its comfortable lead, and the Hang Seng brings up the rear. Energy was the dominant theme on commodity markets. Precious metals lost their shine towards the end of March, and coal pulled back from its recent highs. Natural gas rose even further, but the so-called battery metals, lithium, nickel, and cobalt, all performed strongly. Over the past year, these three commodities also stole the limelight, along with oil, coal, gas, and uranium. Platinum group metals were the wooden spoonists over the same period. Even though rising US interest rates are supportive of the US dollar, some emerging market currencies gained ground against the greenback in March. The main reason for this was the simultaneous surge in commodity prices. Oil producers like Mexico and Indonesia benefited, as did coal and metals producers like South Africa, Brazil, and Chile. The odd one out was Russia, where sanctions negated the benefit of higher commodity prices. Looking ahead, we remain hopeful that Russia's invasion of Ukraine will run out of steam eventually. The oil price should pull back irrespective of whether it does, but continued tensions will be bad news for Europe because of its heavy reliance on Russian gas. Higher commodity prices are negative for both GDP growth and inflation. While the US Fed seems determined to stamp out inflation, the Europeans and Chinese seem far more dovish for now. Against the backdrop of slower growth and higher interest rates, company earnings are likely to be less stellar than last year. Our considered view is that 2022 will be a tougher year than 2021, but that fears about the recession and bear market are overdone. One of the key upward pressures on South African inflation in recent months was the price of fuel. In March, motorists had to endure a particularly painful price hike, with the petrol price rising by R1.46 per litre and diesel by R1.44. In an effort to soften the blow, the Treasury announced that it would reduce the general fuel levy by R1.50 per litre during the months of April and May. The reduction is to be funded by selling a portion of government's strategic crude oil reserves. While certainly welcome, this step will at best offer temporary relief, as government cannot continue to forego R3 billion in tax revenue per month indefinitely. By the end of March, over 3.7 million South Africans had tested positive for COVID-19, and more than 1 million people had succumbed to the disease. Around 33 million doses of vaccine had been administered, and 17 million people had been fully vaccinated. With hospitalizations and deaths continuing to decline, government has indicated that it is considering an end to the state of disaster, which has now been in force for over 2 years. The wearing of masks outdoors is no longer mandatory, and sports fans are jubilant at being allowed back into stadiums once more, even if only at 50% capacity. The South African economy grew at a pleasing rate in the fourth quarter of 2021 and by 4.9% for the year as a whole. Despite this, our GDP is still smaller than pre-COVID in real terms. Unemployment keeps on getting worse, and nearly half our adult population was unemployed by the end of last year. Consumer price inflation was unchanged at 5.7% in February, but given rising producer prices, it looks set to accelerate over the coming months. The Reserve Bank unsurprisingly hiked the repo rate by 0.25% in March, and Moody's raised our ratings outlook to stable. Sadly, South Africa is unable to capitalize on rising commodity prices by exporting more because our railways and ports are unable to handle additional volumes. One of the biggest constraints on our economy's ability to develop and grow is the lack of cheap and reliable electricity. Despite the valiant efforts of Andre de Ruyter's management team and the building of 2 mega power stations, Eskom remains unable to keep South Africa's lights burning. In fact, 2021 was its worst year ever in terms of lost megawatt hours. More output was lost due to load shedding over the past 2 years than in all years combined since rolling blackout started in 2007. South Africa's government finances may have improved somewhat in recent times, but there is no doubt that they remain in a perilous state. We simply have too many people who depend on government for financial survival and not enough who contribute to tax revenue. This infographic places our dilemma in a global perspective. Our top marginal personal income tax rate, shown on the vertical axis, is comparable to those of rich, developed countries like the United Kingdom and Germany, while personal income tax as a percentage of GDP, shown on the horizontal axis, is also far higher than one would expect of a middle-income country. The Russian invasion of Ukraine and subsequent sanctions against Russia pose a major threat to the food security of many African countries. Russia is the world's biggest wheat exporter and Ukraine the fifth biggest. In 2020, South Africa imported more than a third of its wheat needs from these two countries, and 16 other African countries relied on them for more than half of their wheat needs. Two of them, Benin and Somalia, imported all of their wheat consumption from Russia and Ukraine, and Egypt, with its more than 100 million consumers, more than 80% of its consumption. The JSE All-Share Index ended the month down by 2.1%. The industrial and resources indices both lost ground, but the financial index was up sharply. The rand firmed on the back of strong commodity prices, and bond yields ended the month flat. Prosus has had to cut its losses in Russia, both in terms of its social media platform VK and its classified ads business Avito. Rand Merchant Insurance Holdings has announced that it plans to unbundle its stakes in Discovery Outsurance and Momentum Metropolitan, and Anglo American has sold its remaining stake in Thungela Resources. Thanks to a sustained surge in mining and agricultural commodity exports, the rand has been one of the best performing emerging market currencies against the US dollar for the year to date. The spot exchange rate of the rand, the black line, had appreciated by 10% by the end of March, whereas the weighted index for emerging market currencies, the pink line, had risen by less than 1%. In real terms, in other words adjusted for inflation, The rand has appreciated by 16% against the US dollar so far. The stronger rand and South Africa's improved fiscal outlook has seen foreigners rediscover their appetite for South African securities. Both the JSE and the local bond exchange saw significant inflows of foreign capital during the month of March, and for the year to date, the JSE has seen an inflow of nearly 28 billion rand and the bond exchange 18.5 billion. The current Adviceworx tactical asset allocation view can be summarized as follows. We see value in domestic equities and are looking to increase our exposure to this asset class by 1 to 2%. We retain our overweight position in domestic bonds and our underweight position in domestic cash. We also retain our underweight position regarding domestic property. On the international front, we are still positive about equities despite the stretched valuations, and we retain our maximum underweight position relative to global bonds. As far as international property is concerned, we remain positive on the asset class. Thank you very much for your time and interest. We certainly live in interesting times, and I hope that the contents of this presentation will help you make sense of it all. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I wish you good luck and good health until next time.